Hey guys, this is your host Nitin Binhani, and a very warm welcome to my startup podcast channel Jazair Audio, where we share real stories with real learnings.
In today's podcast, we're tackling a key question that has gripped the Indian startup ecosystem. Did Reliance kill Dunzo? Dunzo is no stranger to the Indian audience. Founded in 2014 by Kabir Biswas, this hyperlocal delivery platform began with a vision to get anything delivered to your doorstep within the same city. Be it groceries or medicines, Dunzo quickly became synonymous with convenience. But today, Dunzo stands at a precarious juncture with reports of distressed sales, massive write-offs, and its last remaining co-founder, Kabir Biswas, considering an exit and is set to join Walmart-owned Flipkart's quick commerce division, Minutes. How did it come to this? Let's break it down into stages. 1. The rise of Dunzo. Dunzo's story started in Bengaluru, where Kabir Biswas launched the platform with a simple WhatsApp service for delivery requests. The idea struck a chord with urban millennials seeking convenience. Its initial traction caught the attention of VCs. In December 2017, Dunzo received $12.3 million in Series B funding from Google, Bloom Ventures, and Espada. In 2020, Dunzo decided to gamble with market with the launch of Dunzo Daily. The big break came in January 2022. Dunzo raised a $240 million funding round in which Reliance Retail invested $200 million, acquiring a 25.8% stake. This investment valued the company at a whopping $775 million. Reliance's strategic interest was clear. The quick commerce market in India was on fire, projected to reach $6 billion by 2025. Dunzo, with its hyper-local delivery model and established presence, seemed like the perfect vehicle to tap into this opportunity. Reliance's deep pockets and extensive retail network promised to amplify Dunzo's growth in the competitive quick commerce sector. This partnership, while infusing much-needed capital, also brought with it veto powers for reliance on significant company decisions. 2. The challenges began. Despite raising over $400 million, Dunzo's USP of hyperlocal expertise began to fade, and the company struggled to keep pace. The quick commerce space is notoriously difficult, with razor-thin margins and high operational costs. Competitors like Swiggy's Instamart, Zomato's Blinkit, and Zepto were all battling fiercely for market dominance. Despite its early mover advantage, Dunzo struggled to scale its operations beyond a few cities. Its ability to compete was hampered by limited funding compared to its rivals, who continued to raise capital at staggering valuations. Operational inefficiencies also became apparent. Quick commerce requires a robust supply chain, efficient warehousing, and a steady delivery fleet. Scaling these elements while maintaining affordability is a Herculean task. For Dunzo, the economics simply didn't add up. Losses piled up as the company spent heavily on discounts, marketing, and delivery logistics. 3. Reliance backs out. By mid-2023, the cracks in the Reliance-Dunzo partnership were evident. Reports surfaced that senior executives from Reliance Retail had stepped down from Dunzo's board. This move signaled waning enthusiasm from Reliance, which seemed to be losing faith in Dunzo's ability to turn things around. Then came the bombshell in January 2025. Reliance Retail wrote off its entire $200 million investment in Dunzo. According to insiders, Reliance viewed the quick commerce market as increasingly saturated and unsustainable, especially given the mounting losses across the sector. 4. Dunzo's freefall. For Dunzo, Reliance's exit was the beginning of a downward spiral. The company's valuation plummeted from $775 million to an estimated $25 to $30 million, a staggering 96% drop. Talks of a potential acquisition by Swiggy, Big Basket, or Flipkart have reportedly fallen through, leaving the company in a desperate bid to find a buyer. The situation is dire. Employees and vendors have raised concerns over delayed payments, and rumors abound that co-founder Kabir Biswas is considering stepping down. In fact, Biswas has reportedly joined Flipkart's quick commerce division, Flipkart Minutes, as head of operations. While this might be a promising opportunity for Biswas personally, it leaves Dunzo without its visionary leader at a critical juncture. 5. Analyzing the blame game. So, did Reliance kill Dunzo? The answer isn't black and white. Reliance's decision to write off its investment undoubtedly dealt a severe blow to Dunzo, but the startup's challenges run deeper. Let's examine the factors responsible for the downfall. Market competition. The quick commerce space is overcrowded, with giants like Swiggy, Zomato, and Zepto dominating the field. These players boast larger war chests and more extensive networks, making it difficult for Dunzo to compete. High operational cost. Quick commerce is a cash-guzzling business, maintaining warehouses, ensuring 10 to 15-minute deliveries, and subsidizing customer discounts are incredibly expensive. For Dunzo, these costs became unsustainable. Reliance's strategic shift. Reliance's initial investment in Dunzo was part of its broader push into digital and e-commerce ventures. However, as Dunzo's losses mounted and the market became increasingly challenging, Reliance chose to cut its losses and focus elsewhere. Internal missteps. Some analysts argue that Dunzo could have pivoted to a more sustainable business model. Instead of doubling down on quick commerce, the company might have explored other revenue streams, such as enterprise logistics or B2B services. 6. The bigger picture. Dunzo's predicament reflects a larger trend in the startup ecosystem, the shift from growth at all costs to sustainable profitability. In the early 2020s, startups were flush with cash, thanks to record-breaking funding rounds. However, as global economic conditions tightened, investors began prioritizing profitability over expansion. Companies like Dunzo, which relied heavily on external funding, found themselves in a tough spot. Moreover, the quick commerce sector's economics have come under scrutiny. While the promise of 10-minute deliveries is alluring, the costs involved make it a challenging model to scale. Even major players like Swiggy's Instamart and Zomato's Blinkit have struggled to achieve profitability. Lessons learned. What can startups learn from Dunzo's story? Here are a few takeaways. Focus on unit economics. Growth is important, but not at the expense of sustainable unit economics. Startups must ensure that their business models are viable in the long run. Diversify revenue streams. Relying on a single revenue source can be risky. Exploring complementary business lines can provide a safety net. Choose investors wisely. Strategic investors like Reliance can be a double-edged sword. While their funding and resources are invaluable, their decisions can also be influenced by broader corporate strategies. Adapt to market realities. The ability to pivot and adapt is crucial for survival in a dynamic market. Dunzo's reluctance to move away from quick commerce might have sealed its fate. So, to conclude, Dunzo's story is a cautionary tale for startups navigating hyper-competitive markets. It's a reminder that innovation and ambition must be balanced with practicality and resilience. So, did Reliance kill Dunzo? The answer is not entirely. Reliance's exit certainly exacerbated Dunzo's troubles, but the startup's downfall was the result of a perfect storm of internal and external challenges. Folks, that's it for today. Thanks for tuning in. Please like, comment, and subscribe to the channel. Join us next time as we continue exploring the dynamic world of startups and the valuable lessons from their journeys.